Thank you so much, ladies and gentlemen, and welcome again to our today's video. And today we are going to talk about something very interesting, very educative about savings and investing. Savings stroke investing. Now, based on this particular topic, ladies and gentlemen, we shall be asking ourselves, why is savings not enough? Why is savings alone not enough in our today's economy? Why do you need to go an extra mile of making sure that you invest your money? Because in most cases, as much as we talk about savings and making sure that you put aside some percentage of the income that you get, probably 20%, 30%, even 50%, based on the expenditure that you have or the kind of living or the kind of lifestyle that you are going to have, why is savings alone not enough? Why is savings alone not enough? And you need to go an extra mile of investing your money. So ladies and gentlemen, if you stick with me in this particular video, I shall be giving you 5 reasons, 1, 2, 3, 4, 5. Yeah, 5 good reasons why savings alone is not enough in our today's economy, and why you need to go an extra mile of making sure that you multiply that amount of money. So ladies and gentlemen, this is another reason that you should stay subscribed in this particular channel. And if you're seeing me for the first time, my name is John. My name is Sir John Mweri. I'm a professional accountant with ex-FinOp accountancy and insurance consultancy. And of course, those who have been watching me for quite some period of time, you know this is what we normally do: give you the financial information that you need so that you can have a smooth financial journey, and of course make sure that you have an effective financial journey. So ladies and gentlemen, without wasting time, I want to dive into my content of today so that we can be able to help each other. Now ladies and gentlemen, of course, just like the old days, I have some notes here. So when you see me looking on this particular side, I'm just confirming what I've written here. So we are asking ourselves why savings alone is not enough. Why savings alone is not enough. Why saving alone is not enough, or why savings alone is not enough. So ladies and gentlemen, our point number 1 on why savings alone is not enough, it's because of inflation eats your money. It's because of the purpose of inflation. The moment, yes, you have earned your income, you have received your income, be it 100%, be it 200,000, 500,000, based on the income, whichever amount that you are receiving. And then you have decided that I'm going to put aside 30%, 20%, 50%, whichever percentage that you're comfortable with or based on your budget. And then you say that this amount I'm going to save. Now, before I continue, let me put this one on the whiteboard. Inflation eats your money. Inflation eats your money. Now, before I even explain that, for those who doesn't know what is the meaning of inflation, ladies and gentlemen, inflation is increase in the prices of goods and services. For example, if just like 5 years ago, a bottle of soda was costing 50 shillings. Now, after 5 years, a bottle of soda is costing almost 100 shillings. Now, that is what we call inflation. Increase in the prices of goods and services. For example, again, if a bag of potatoes 5 years ago was costing like 3,000 Kenya shillings or 3,500 Kenya shillings, and then if you go to the market today, a bag of potatoes is costing almost 7,000 Kenya shillings. That increase from 3,500 to 7,500 or 7,000 is what we call inflation. General increase in the prices of goods and services. Now, when we talk about services, if you went to kinyozi or salon and you used to get your hair done with 2,000 Kenya shillings or 2,500 Kenya shillings. But with time, you have noticed that there is an increase in the price of the services that you are being given in that kinyozi or salon. Probably you used to pay 500 Kenya shillings. Right now you are paying 1,500 Kenya shillings. That increase in the price of that service is what we call inflation. And when we talk about inflation, what inflation do, that general increase in the prices of goods and services, what it does is it diminishes the value of the money you have. At that particular moment, 500 was enough to do your hair or whichever service that you are receiving. But right now, as we talk, 500 is not enough to do with your hair. So that value of 500 has been diminished to the extent that it cannot give you the service that it was giving you 5 years ago. And right now, so that you can get the same service, you need to extra add 1,000 Kenya shillings so that you can receive that particular service. So ladies and gentlemen, that is what we mean by inflation, increase in the prices of goods and services. Now, how does it relate to inflation eats your money when you save a loan? How does it relate that when you save a loan, it's going to eat your money? Now, ladies and gentlemen, if you just save your money in a bank account, it means it earns 0% interest, right? It means your money earns 0% interest. As we talk, inflation is at 4 to 5% per annum. Inflation is at 4 to 5% per annum. So that if you have saved 100,000 in January 2025, if you have saved 100,000 in January 2025, probably, just an example, if you saved 100,000 in January 2025, this money is 100% when you saved that money. It was 100% when you saved that money. But at the end of the year, if this money is in the bank account and it's earning 0 interest, it means it will reduce in value by the end of the year. How is it going to reduce in value? Remember, we have an inflation rate of 5%. That means if the inflation rate is 5%, what your 100% will reduce by 5%. So what about 95%? What about 95%? So ladies and gentlemen, you might be having the 100,000 at the end of the year. You see it as 100,000, but in real sense, the value of that 100,000 has gone down. The amount of goods or services 100,000 could have bought in January 2025, it is not the same amount of goods and services 100,000 is going to buy or to purchase in December 2025. So look at here, ladies and gentlemen. So you are going to multiply 95% times 100,000 divided by 100. So let's see about this. 95% times 100,000 divided by 100. So this is 0.95 times 100,000 then divided by 100. So it's going to be sorry for that. Divided by 100, this is going to be 0.95 times 100,000. So that is 95,000, ladies and gentlemen. That is 95,000. So if you save this amount in a bank account, you see it as 100,000, but it is not physical seeing that, oh, you are saying that it has reduced by 5%, but it is still 100,000. No, we are talking about the buying power of that particular 100,000. Probably the buying power of 100,000 in January 2025 could have bought a certain amount of goods and services. But in December 2025, that money has reduced in value by 5% due to inflation. So therefore, the amount of goods and services that 100,000 could buy in January, it's not the same amount of goods and services that 100,000 could buy in December 2025. So that is the simplest explanation of inflation for those who doesn't know what is inflation, because we normally talk about inflation, and a lot of people do not understand what is inflation. So I have explained what is the meaning of inflation to you. It is where the money is reduced to an extent whereby the buying power of that particular money has been reduced. And I've given you a very beautiful scenario of that. So ladies and gentlemen, if you save your money is in a low or no interest earning account, if you save your money in a low or no interest earning account, then inflation is going to eat your money. You might see it as 100%, but in real sense, the buying power of that particular amount has been reduced. So ladies and gentlemen, let's go to our point number 2 on why saving alone is not enough. Let's talk about low or no interest rates. Low or no interest rates. Now, low or no interest rates. Of course, this one goes without saying, without even further explanation, ladies and gentlemen. When you put your money in a bank account, again, when you put your money in a bank account or M-Pesa, all right, or M-Pesa, you have saved your money in a, your pesa yako inakanga tu kwa M-Pesa ama inakaa kwa bank. So you have put your money in a bank account or M-Pesa or any other account that does not have a competitive interest earning or a return. So you are going to have no interest rates in that particular account. And therefore, remember, our inflation is still at 5%. So therefore, you see, the math is not mathing. So, or you put your money in an account with 2% to 3%, but inflation is 5%. So you think that you're earning this amount, 2% or 3%, but remember inflation is at 5%. That means, no, instead of your money losing value by 5%, now it's losing value by probably 3% or 2%, because here 2% or 3% has been covered by what you are earning. So ladies and gentlemen, here is what now we talk about low interest rate. So you earn a low interest rate, but remember, still the inflation is still, doing that what it's supposed to be doing. And when you put it in a bank account or an M-Pesa account, then you are having no interest, and therefore actually what you are doing is losing some amount of money and so on and so on. So ladies and gentlemen, that's why savings alone is not enough. You need to go to an extra mile and look for a place whereby you can put that particular amount of money and see that it has given you some competitive returns or given you something in return. And then, ladies and gentlemen, at the end of this video, I'm going to give you a disclaimer of where you can put your money to get a competitive return, even other than money market funds or stocks and whichever you are thinking about right now. Because money market funds are good because of compounding, but there are so many accounts or areas you can put your money that you're going to have a high return at the end of the investment period. So I'm going to give you a disclaimer at the end of this particular video so that you can have a clue on where you can invest your money. So ladies and gentlemen, let me go to my point number 3, missed growth opportunities. Missed growth of opportunities. Missed growth opportunities. Now, ladies and gentlemen, you remember when we talk about risk. When you talk about risk, we say that there are risk-averse people, there are risk-neutral people, and there are those people who are risk takers. So we have risk takers, we have risk-averse, and risk-neutral. Now, when we talk about missed growth opportunities, we talk about these people, yes, they have savings, they have put money in their bank account, but because they are risk-averse, these are individuals who doesn't want to take any risk. They have the fear of failure. They have the fear of losing that particular money. That is when they miss growth opportunities. Now, when you fear that if I put this money in a money market fund account, this fund manager could collapse, you see, you have missed growth opportunities. There is someone who is having 1 million Kenya shillings in a bank, and then you say, oh, people are investing in money market funds. These accounts are going to collapse in future. Who told you they are going to collapse? Now you see, you are procrastinating, and at the same time, you are a risk-averse person. You think that you have a kind of an investment whereby you are going to be 100% assured that your money is going to be secure. That one cannot happen on this earth. Each and every investment that you undertake, whichever kind of an investment, even dealing directly with the government, there is some amount of risk that you normally take. But what the most important is, how do you calculate risk and how do you make sure that you have taken a calculated risk and how you mitigate those particular risks. So ladies and gentlemen, being a risk averse person to some extent is going to make you miss growth opportunities. You could invest 1 million in a money market fund account. It's compounded in 1 year, and then at the end of the year you have like almost 100,000. So ladies and gentlemen, that 100,000, you cannot earn it if your money is in a bank account. But the moment you take the risk of putting it in a money market fund and just making sure that you have mitigated risk first, check if the money market fund is regulated by the Capital Markets Authority. Look at the custodians and the trustees of the money market fund. Look at the history of that fund manager, and so on and so on. Look at how the asset allocation of that fund manager has been done, so that you can say that now this is the money market fund I choose, or this is the account, or whichever buying of stocks, or this is the broker I choose, so that I can be able to invest my money. But ladies and gentlemen, when you put that money in a bank account earning nothing, you miss growth opportunities, and that 1 million of yours is going to have lost in value by 5% at the end of the investment period, or at the end of that financial year. So ladies and gentlemen, missed growth opportunities is another reason why saving alone is not enough. Now let's go to my point number 4, and we are talking about it delays financial freedom. It delays financial freedom. Ladies and gentlemen, sorry to say, but when we talk about financial freedom, when we talk about the lifestyle that you want to live in the coming years, when we talk about what you are dreaming or what you want to have, when we talk about you sitting there doing nothing, but at the same time you are receiving some amount of money, when you talk about you earning money that you are not putting a lot of effort so that you can be able to earn, you cannot do that without investing. We cannot do that without investing. And when you talk about that it delays financial freedom, number one, if you have money, probably you just save, you just keep aside, or even you withdraw as cash and you put it in your drawers of the house, and you're just putting that money as cash. So that money is not working, it's not earning anything, it's being affected by inflation, and it's losing in value. Now you might even accumulate to 5 million, it's okay, but as long as that money is not invested somewhere, as long as you did not buy an asset, as long as you have not opened a business somewhere so that you can multiply that money and just make sure that you have maintained the value of that particular money, that money is is equal to money lost. Because one day you'll just wake up and decide that I'm going to use that money, and you are just going back to zero and starting from the scratch again. So ladies and gentlemen, don't be happy when you have cash that you are seeing. Don't be happy when you have cash that you can access very fast. You see, like I have 100,000 in my bank. Let me withdraw so that I can see it here, you know. So that one is very dangerous, because the temptation is that you might lose that amount anytime. You might decide, oh, this bed is very beautiful, I like this bed. Oh, I want a big screen TV, and it's something that you have not even budgeted for. It's something that you don't need. Probably you even have a TV in your house, but you just feel that because you have some money, you want to spend. Now, ladies and gentlemen, simply because you have some money in your pocket doesn't mean that you must spend that money. You can even decide to invest and get some returns. If kabisa you don't need whatever you want to buy, it is just the urge and the kamchecheto of having money that is pushing you to buy that particular item, you don't need to buy it. And that's why I normally encourage individuals, when you have money that is idle, do not be having money that is idle. Do a budget, make sure that you allocate all the money, let the remaining money go to investments. You can even buy cows at your home and just cease to see the real cash. Just see assets, something that could take some time to convert into real cash. And that's how you are going to make sure that you have secured your financial freedom. Remember, investments and assets is what totals to your wealth. But liquid cash, those are just cash and cash equivalents. They are not going to help you because cash and cash equivalents do not earn any interest. So ladies and gentlemen, it delays your financial freedom, and that's why saving alone, it's not enough. So ladies and gentlemen, take care of that. Do not be having idle cash. Just make sure that you find something to do with that particular money. Now, and the last one, ladies and gentlemen, very simple: no wealth growth. No wealth. This is my point number 5. No wealth growth. Now, of course, it goes without saying that when you have not invested your money anywhere, in any investment, you have not purchased any asset that is generating some income for you, you don't have wealth. You just have liquid cash. Ladies and gentlemen, let me surprise you. You might be having 10 million Kenya shillings, or someone puts 10 million Kenya shillings in your bank. But if someone comes and tell me my net worth, your net worth is not that 10 million Kenya shillings. Your net worth is the assets that you have. Yes, cash is asset, but is it an income generating asset? It becomes an income generating asset when that cash is converted into real assets that can be used somewhere else and generate the same cash. But when that cash is there and idle, you will just be taking small. You take 100k, now it ceases to be 10 million. So the net worth that you are saying that is net worth, actually it ceases to become, starts going low. So but when you take the whole 10 million and acquire assets that are going to generate income, when those assets are evaluated or revalued, you can see that they could even increase. For example, you acquire assets like land, machinery, buildings, and so on and so on. And then when they start generating income, you can even tell someone, you see, this asset is going to generate you income for the next 10 years or for the next 20 years. So when you value it, you even value based on the amount of cash or the profits that is, or the service that is able to give for the next 10 years or 20 years. It's not just as an asset. But when you take the cash, the 10 million is just going to be evaluated by 10 million Kenya shillings. So ladies and gentlemen, when you don't invest your money and you just save it alone, then you don't have the opportunity of wealth growth. So ladies and gentlemen, when you want to grow your wealth, you must make sure that you have invested your money but not saving alone. Now, ladies and gentlemen, having said those 5 good points, that is inflation eats your money, low or no interest rates, missed growth opportunities, it delays financial freedom, and no wealth growth. Having said that, now let me just give you a disclaimer of where you can put your money to make sure that it's competitive. Now, if you are a risk-averse person, we have financial instruments that you can put your money that are going to have a low interest rate because they are going to have low risk. And any investment that is going to have low risk, then it means it have low returns. For example, look at money market funds. Money market funds are going to have low returns. Of course, right now we are talking about even less than 10% because they have gone down. Now, money market funds, the only advantage you have with money market funds is because of compounding. That even the profits that was earned today is going to be part of the principal to be multiplied tomorrow. So that is the only advantage. So, but they have low returns. Now, them being or having low returns, it means they have low risk. So you could put your money in an investment account like a money market fund account if you are a risk-averse person. If you are this kind of a person who feel like you cannot do business, you can put your money in such account. You can also put your money in a bank fixed deposit account. But instead of putting your money in a bank fixed deposit account, I would rather you put it in a money market fund account, because at least money market fund is going to compound your money. But when we talk about bank, those are just a simple flat interest rate that you are going to get. And of course, there will be some charges for that. So ladies and gentlemen, for those who are risk-averse people, you can do money market funds, you can do treasury bills, you can open a CSD account with the Central Bank of Kenya and decide to do treasury bills. Of course, those are low risk again, because they have low returns. Treasury bonds, ladies and gentlemen, those are long-term investments, so I would not advise you to do that if you don't plan to do long-term investments in treasury bonds, because I even encourage people to have a lot of money so that you can enjoy the profits of treasury bonds. But when it comes to treasury bills, the 3 months, 365 days, and so on and so on, that one you can do and get some competitive returns. But the most one I encourage is money market fund, because of the aspect of compounding, low risk, diversification, and such kind of things. Yeah, so ladies and gentlemen, that is someone who is a risk averse person. Now, if you are a risk taker, you could do business. You can open a business somewhere. Of course, someone who opens a business, you know the risk that you normally, actually the level of risk that you are taking to open a business is high. But of course, you are assured that when you open a business and it peaks, then you are assured that you are going to have a high return from that particular money. Of course, businesses are going to multiply our capital very fast, and even the break-even point could be reached very near soon, and so on and so on. So if you are a risk taker, you can do businesses, you can do investment in biological assets, you can do investment in biological assets. For example, you can buy sheep and put them in a ranch, you can buy cows, you can do farming. Those kind of investments are high risk investment, but they have high returns. So those are the kind of investment and where you can put your money as an investment. That is a person who is a high risk taker. Or even if you are not willing to do such kind of things, you can lend money. There are those people who are very desperate with being liquid, or probably they want to finance something in their businesses. You can lend money and probably charge 20% interest rate or 30% interest rate, but make sure you charge on short-term basis, so that again you may not lose your money. But be very careful on that particular business of giving money to small businesses or individuals who want to sort out their needs, so that you may not lose your money on the process. So those are the people who have high risk, who want to take risk. Now, they are risk neutral people. You can either choose to be on this side of money market fund or the other side of doing farming and so on and so on, or you look for an investment that is a middle risk, such kind of a thing. So ladies and gentlemen, there are so many ways in which you can invest your money, and just making sure that you don't save your money alone, because when you save your money alone and you think that your money is secure, it is not secure in terms of losing value, it is not secure in terms of inflation. So ladies and gentlemen, those are the 5 reasons why you should not save your money only, but also consider putting your money in an investment account. Thank you so much, ladies and gentlemen, for watching that particular video. Again, if you're seeing me for the first time, my name is Sir John Mweri. I'm a professional accountant with X-Finop Accountancy and Insurance Consultancy. And this is another reason, ladies and gentlemen, you should stay subscribed in this particular channel, because this is the kind of information that we normally bring to you, information that is going to help you and make sure that you have a straight financial path. More and more to come, ladies and gentlemen. Stay subscribed, make sure you hit the notification bells, and so that anytime I upload a video, you're the first person to get this particular video. Again, don't remember to share this video to the friends, so that we can have everybody and the community at large educated. Thank you so much for watching. That was my time. See you on the next.